Welcome back. Today we are discussing our December rate update for 2021. There's some interesting things going on in the market, some really great rate specials out there, and some interesting things happening with the bond market, which should indicate that rates are going to go down. However, we just got a notification prior to filming that interest rates may go up. So we're going to discuss all of that after the intro. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so welcome back to the December interest rate update. We are going to talk about all things discounted mortgage, all things full-featured mortgages. We're going to talk about the bond market and what's happening there, and we are going to talk about the rate specials, which I think are really intriguing at the moment, especially if you're a variable rate borrower. So let's start off first and foremost by making sure that you've clicked that subscribe button, hit that like button, hit that notification bell, and don't forget about our race 25,000 subscribers, where if you subscribe, you have a chance to win $5,000 when we hit 25,000. So you have to be entered to win. Go ahead, click that subscribe button. It's free, it's easy, it's definitely worth it. And let's start by talking about the bond market. So some interesting things happened at the end of November here. First and foremost, Omicron became the new variant of concern with respect to the coronavirus. That led markets on Friday to fall, with rate expectations being pushed back with respect to timelines of when interest rates are going to increase in both the US and Canada. Then we saw a really good market day on Monday, and then we saw Jerome Powell on Tuesday come out and say that they're looking at tapering the Fed's bond buying program, and therefore that they may be increasing rates sooner. So basically what happened was on Thursday of last week, it was expected that the US Federal Reserve would move interest rates sometime around June. Then that got pushed back on Friday to September. And then when Jerome Powell said that they're going to relook at their tapering program, that got pushed forward back again to June. So basically nothing happened from the perspective of when it's expected that interest rates are going to go up. However, what did happen was there was about a 20 basis points fall in 5-year bond rates. And what that should lead to is that should lead to a drop in 5-year fixed mortgage rates. Now, just to kind of show you what this looks like, this is the 5-year bond yield. Last month when we showed this to you guys, it kind of looked like this right here. And then in the last couple of days here, you see this big drop of about 20 basis points, which should equate to about a 0.2% decrease in interest rates in the coming days. Now, this is interesting though, because we just got notification from one of the lenders, actually two of the lenders that are funded by one of the big banks, and they are increasing interest rates. So even though the bond market has come down, they're basically saying that they're increasing their interest rates. Now, this could be something to do with their books of businesses being full for the year. This could be something to do with cost of funds changing, but for the most part, this isn't what should be happening. So it's going to be interesting to see what happens with the other lenders, and in particular, the lenders that are funded by other banks, to see if they follow suit and also increase their interest rates. Sometimes they do, sometimes they don't. But when we're in a scenario where cost of funds has decreased, it's not likely that the rest of them are going to follow suit and increase interest rates. So we'll see what happens in the coming days. So if the rates change, we are going to come out with a new video. We'll tell you what the rates change to, but as of now, here's what the full feature rates look like. So if you are buying with mortgage insurance, so putting less than 20% down, or you're putting greater than 35% down, these are the two types of mortgages where the bank has the least exposure and the least risk. You can get, as of right now, a 5-year variable at 1.15%. Now, we've seen one lender already say that they're going to pull that back as of tomorrow. The other primary lenders that are offering this have not gone down that road yet. Time will tell. There is still some time to get a prime minus 1.3% interest rate or a 1.15% interest rate on a variable if you're borrowing with less than 20% down. So if you're in that category, get your application in, go to mortgage360.ca, click apply now, and make sure that it's in the queue so that we can get it handled and we can get that rate locked in for you. By the way, it's first come, first serve, so make sure you're on top of it. As far as 5-year fixed rates go, really no change here. We're still at 2.59% if you're looking for a 5-year fixed with full features. What I mean by full features is you can leave the lender at any time as long as you pay the penalty. Most of these lenders have low penalties. Most of them do not have things like no refinance clauses, and they have full prepayment features. So you can pay 15 or 20% back annually without penalty. Now, getting to 20 to 35% down payment, 5-year variables are now at 1.35 to 1.45%. 5-year fixed are at 2.64 to 2.74%. Obviously, if you're putting more down, you're paying less. And if you're putting less down, you're paying more. So if you're putting basically 20 or 25% down, bank on 2.74. If you're putting 30 to 35% down, bank on 2.64. Now, getting into discounted rates, and we always begin the discounted rate conversation with what is a discounted rate? Well, it is a rate that comes with restrictions. It's like anything else in life, you get what you pay for. And when you have a mortgage product that has less features, you're going to get a better rate. And if you have a mortgage that is at a lower rate, you're going to have less features or higher penalties or a combination of both. So anytime that a bank tells you, hey, go out and get a lower rate than what we've offered you and we'll match it. Well, when they go to match it, keep in mind that it's one of those things where you do get what you pay for. And if you get a lower rate from them, you are probably getting features taken away, or you're going to have higher penalties or a higher lock-in rate somewhere down the road if you're getting a variable. Highly recommend that you talk to a broker, because a broker can save you from all the landmines and surprises that you don't know are coming. I talked to a lady yesterday. She had all kinds of opinions and ideas about her variable rate versus fixed rates and how she was going to do things. She was one of those cases where she just didn't know what she didn't know. She likely went and got a 5-year fix with a big bank just because she was sure that that was what she should have gotten. And what she probably doesn't realize is that she's going to have a significant penalty on it. She probably didn't get the best product. And at the end of the day, she told us that she's going to pay the mortgage out sooner than what she had expected, or than 5 years. So that penalty is going to come back and haunt her. But no matter what we told her, she would not listen to us. And that's what I see our job as brokers as being, is making sure that we help you avoid the landmines, the surprises, the things you don't know that you don't know. So keep that in mind when you're going out and you're shopping for rates. If you're shopping for rates and you say, give me your absolute best rate, what you're actually saying to people is, give me the mortgage that has the least amount of features and that could cost me more down the road. So let's get into discounted rates. This one's come down a little bit since last month. You can now get a 5-year variable at 1.1%. If you can get a variable at 1.15%, and have full features, this mortgage makes 0 cents. So I highly recommend you avoid this one. Pay the extra 5 basis points, it's a cup of coffee a week, and it will give you significantly more savings over the long run. 5-year fixed at 2.39. Again, you can't get out of this mortgage in the future unless you sell the property. So keep that in mind. Then getting into 20 to 35% down payments, we have 5-year variables at 1.1% to 1.2%. And 5-year fix at 2.44 to 2.54. Now let's talk about something that we don't frequently talk about. Let's talk about rate specials, because there is a rate special out there right now for variable rates. It is for insured or greater than 35% down payment. It is a 3-year variable at 0.99%. Actually, don't quote me on the greater than 35% down payment. It actually may not be available on that, but if you're buying with less than 20% down, it is definitely available to you. 3-year variable, prime minus 1.46, 0.99%. Now let's talk about strategy on this one. Let's think about this. So 3-year variable at 0.99% or 5-year variable at a slightly higher 1.15%. Which would you choose? Well, there's a reason why they're pricing a 3-year less than a 5-year. It's because there's probably some expectation that variable rate discounts are going to get reduced over time. And as a result, in 3 years, when you go to renew this mortgage, you're probably going to get less of a discount and they're probably going to make some money back off of you. So if I had to choose at a 0.16% difference between a 3-year and a 5-year, I'd probably choose a 5-year to make sure that I had a bigger discount for longer. Now that's just me, but that is one of the things you have to consider when you're looking at shorter term mortgages is, what is the play here? Why is the bank offering it? Why is it something that is available? And why is it something that they are trying to sell so hard? And in this case, I think this is probably a good mortgage if you're on a 3-year timeline. But again, if interest rates do start to go up and discounts start to shrink, you could end up paying significantly more 3 years down the road when your mortgage comes up for renewal. So I'm not necessarily a big believer in choosing this mortgage. Obviously, I'm a big believer in variables. I'd rather see somebody choose this product than a 5-year fixed right now, because again, if you can save 1.5% on a mortgage that's $500,000, that's basically like $7,500 in savings per year. That's a pretty big chunk of money. So I'd rather have somebody take this than a 5-year fixed. Obviously, the 3-year timeline is just beyond what there's any predictions for with respect to interest rates. Central banks and economists typically only project out for interest rates on a 2-year time horizon. So really it's anybody's guess what happens 3 years down the road, but it could be something that ends up costing you money. So if you are going to take a 3-year variable rate, what I recommend is that you keep and continue to keep watching the market to make sure that those discounts aren't getting compressed and compressed and compressed, so that if a year or two out, if it looks like they are going to get compressed, you can start looking at changing that mortgage into a longer term 5-year variable or perhaps a 5-year fixed at that time. So really great option. One that if I can still get that 1.15% by the time I apply, I'm probably going to take that for 5 years rather than this for 3 years. But if you are on that 3-year time horizon, this is a really good option. Of course, you guys know where to go to apply for a mortgage, mortgage360.ca. We can help you pretty much across the country. We are licensed I am licensed, I should say, in BC, Alberta, Saskatchewan, Ontario, and anywhere else in the country. We can help you find a really great broker and make sure that you get the right advice and the right strategies. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about our race to 25,000 subscribers. Make sure you continue to watch interest rates. By the way, just because it seems like interest rates are going up doesn't mean they won't come back down. We've seen this with the bond yields. Expect that we're probably going to see some lower rates before we see higher rates, and it's going to take steps and time for interest rates to increase. So don't panic and go in and lock in your variable. Keep it for now until such time as we actually know that interest rates are going to go up. So if you found this video useful, again, hit that subscribe button and we'll see you on the very next one. Cheers.